At the height of a financial crisis, something strange happens. Perfectly valuable assets stop mattering. Banks with billions on their balance sheets start begging for cash. Corporations that look profitable on paper suddenly can't make payroll. Markets freeze, not because value disappeared, but because no one can move. That's the uncomfortable truth most people miss. In a crisis, capital doesn't save you. Liquidity does. And the difference between those two words decides who survives. Right now, this matters more than it sounds, because the modern financial system is built on the assumption that liquidity will always be there, until it isn't. Let's rewind. Imagine a large company. It owns factories, intellectual property, long-term contracts, real estate. On paper, it's rich. Its balance sheet looks solid, plenty of capital. But tomorrow morning, it needs cash. Not next year, not after refinancing, tomorrow. Payroll, interest payments, margin calls, inventory, taxes. And suddenly, none of those valuable assets can be turned into cash fast enough without massive losses. That's the core problem of every financial crisis. Not insolvency, illiquidity. Capital is about how much you're worth over time. Liquidity is about whether you can pay right now. And financial systems break in real time. The reason this feels counterintuitive is because we're taught to think wealth equals safety. More assets, more security. But crises don't care how rich you are in theory. They care how liquid you are in practice. This became painfully obvious in 2008. Before the collapse, banks weren't obviously poor. They were stuffed with assets, mortgage-backed securities, structured products, collateralized debt obligations, entire skyscrapers of capital. The problem was simple and devastating. Those assets couldn't be sold. Not quickly, not at predictable prices, and not without triggering panic. When confidence cracked, liquidity vanished. Interbank lending froze. Overnight funding markets seized up. Institutions that looked healthy on Friday were functionally dead by Monday. Lehman Brothers didn't fail because it lacked capital on paper. It failed because no one would lend to it anymore. No liquidity, no oxygen. And this pattern keeps repeating. In March 2020, at the start of the pandemic, something even stranger happened. The U.S. Treasury market, supposedly the deepest, safest, most liquid market in the world, started breaking. Prices swung wildly. Bid-ask spreads exploded. Dealers stepped back. Investors couldn't sell treasuries without pushing prices down sharply. Think about that for a moment. The asset that underpins the global financial system briefly became illiquid. Not because treasuries were risky, but because everyone needed cash at the same time. That's the defining feature of a crisis. It's synchronized urgency. Liquidity disappears not when assets are bad, but when everyone wants the same thing simultaneously. Cash. Now. To understand why this happens, we need to look at how modern finance actually works. Most financial institutions don't operate on piles of idle cash. They operate on expectations. Expectations that funding will roll over, that markets will clear, that assets can be sold at something close to yesterday's price. Banks borrow short and lend long. Funds promise daily liquidity while holding long-term assets. Corporations depend on commercial markets to function smoothly. The system is efficient until it isn't. When confidence is high, liquidity feels infinite. Credit flows, prices are stable, risk looks manageable. When confidence cracks, liquidity becomes selective, then scarce, then gone. And here's the uncomfortable math. Liquidity is not evenly distributed. It concentrates at the top. Central banks can create it. Large institutions can access it. Everyone else waits. In every crisis, the question isn't who has value, it's who has access. Access to central bank facilities, access to repo markets, access to emergency lines of credit. This is why crises reshape power. Capital represents accumulated past success. Liquidity represents present permission to continue, and permission can be revoked instantly. This also explains why governments and central banks intervene the way they do. When central banks step in, they're not trying to rescue bad investments out of generosity. They're trying to restart liquidity flows before the system seizes completely. Rate cuts don't fix broken balance sheets. They try to restore confidence. Asset purchases don't magically create value. They create buyers of last resort. They are liquidity operations. This is why central banks often act faster and more aggressively than the public expects. Delay turns illiquidity into insolvency. Once forced selling begins, prices fall. Falling prices trigger margin calls. Margin calls force more selling. Liquidity spirals downward. By the time capital destruction is visible, the damage is already done. There's also a quieter irony here. The more sophisticated a financial system becomes, the more fragile it is to liquidity shocks. Complex markets rely on continuous trading. Derivatives rely on collateral. Leverage relies on confidence. Efficiency removes buffers. In good times, this looks like progress. In bad times, it looks like free fall. That's why crises often seem irrational from the outside. Nothing broke in the real economy overnight. Factories didn't vanish. Skills didn't disappear. Demand didn't collapse instantly. But liquidity did. And once it does, rational behavior turns destructive. Selling becomes mandatory, not strategic. Lending stops, not because risk is high, but because uncertainty is infinite. People don't hoard because they're greedy. They hoard because timing becomes everything. This also explains why some assets perform unexpectedly well during crises. Cash, short-term government bills, central bank reserves. Not because they generate returns, but because they offer optionality. Liquidity is the option to wait. Capital locks you into a story about the future. Liquidity lets you survive until that future arrives. This is why companies with weaker balance sheets but strong cash positions often outlast asset-rich rivals during downturns. Why hedge funds obsessed with liquidity constraints survive longer than funds chasing maximum returns. Why governments with monetary sovereignty behave differently than those without it. Liquidity determines who has time, and time determines who can make choices instead of reacting. Zoom out far enough and you start to see the deeper implication. Modern finance isn't just about allocating capital, it's about managing liquidity under stress. The real currency of power isn't wealth, it's access to emergency funding when everyone else is desperate. This is why crises accelerate inequality. Those closest to liquidity sources stabilize first. Everyone else absorbs the shock. And it's why the next crisis will likely look familiar, even if the trigger is different. Whether it's debt, geopolitics, technology, or climate, the failure won't start with collapse. It will start with hesitation. With one market widening spreads, one lender stepping back, one margin call unanswered. Liquidity doesn't disappear loudly, it evaporates quietly. And by the time people notice, it's already priced in. So the uncomfortable question isn't whether the system has enough capital, it's whether liquidity will show up when it's needed most. Because history suggests that when everyone needs cash at the same time, only a few will get it, and the rest will learn very quickly that value without liquidity is just a story you can't tell fast enough. The real question is this: when the next moment of stress arrives, who actually has the time to wait it out, and who will be forced to sell their future just to survive the present?